Stabilization Trust for our biweekly COVID update call. My name is Erin Persons, and along with my colleagues, I'm happy to see many of you back again this week, hoping that your families and teams remain healthy. We'll go ahead and follow our standard format this morning, beginning with our guest speaker, and then moving on to a policy update, and finally, hearing from you about what's happening in your communities. If you'd like to ask a question or provide feedback during our call, you can utilize the Q&A, chat, or raise hand features. With that, I'll go ahead and turn things over to our president, Julia Gordon, to introduce our guest speaker.
Good afternoon, everybody, or good morning for some of you. I'm so glad to have you back on this call. We have found these calls so incredibly valuable. And one of my favorite parts of the call, of course, is all the wonderful experts we've been able to attract and bring to this conversation with you. And today I am delighted to introduce my good friend, Barry Zigas. Barry is a senior fellow at the Consumer Federation of America. He has, prior to that position, he spent a long time at Fannie Mae. Many of you may know him from his time at Fannie Mae. And before that, he ran the National Low Income Housing Coalition. Barry, there is no part of housing that Barry doesn't have expertise on. He's sat on multiple commissions and committees and, investigations. He knows where all the bodies are buried, and even more important, he knows how so many of the different pieces of the housing industry work together. Today we've asked him to come talk with us a little bit about the rental side, as we've been talking mostly about homeownership in the last few calls. And so with that, I'm going to turn it over to Barry.
Julia, thanks so much. Thanks for that lovely introduction, the kind my father would enjoy and my mother would believe. As you know, there was a new bill introduced yesterday, the HEROES Act. It's a massive piece of legislation, and it moves to correct some of the deficiencies and shortcomings that we all found in the CARES Act. And that's nowhere more important than in the rental housing sections. There is quite a bit on home ownership and mortgage relief, but we're not going to talk about that this morning. So let me focus on the rental provisions, which are in section 110201. Let me start by saying, obviously, no piece of legislation ever gets everything completely right or includes everything that's needed, but this one came pretty close. I'll talk at the end about its prospects for moving forward, but we're all just still digesting it. The full text only just came out. I've only just been able to read it earlier this morning. But let me give some high-level summary and then identify some areas that are either unexpected or may provide opportunities that we had not anticipated. So, as I said, in section 110201, there's a long list of specific new appropriations or authorized appropriations to assist with rental properties. So just going down the list, the bill would provide $4 billion for new assistance to public housing authorities, including $1 billion in temporary vouchers for individuals and families who are at risk of homelessness or becoming homelessness, and another $2 billion, that's tenant-based rental assistance, so that's new Section 8. $4 billion for that, $2 billion for public housing authorities on operation and management, so operating subsidies, $15 million for people with AIDS, housing for people with AIDS, the HOPWA program. Of particular interest to this group probably is $5 billion in additional funding for community development block grants, $11.5 billion for the Emergency Solutions Grant program, and this is where things get a little complicated. And then another $100 billion, which I'm going to break down in a minute, another $100 billion also using the Emergency Solutions Grant program, but apparently a revised one. So you've got the $11.5 billion on the legacy ESG and another $100 billion on a slightly expanded ESG vehicle, $750 million in project-based rental assistance, $500 million for support of 202s for the elderly, Section 202s, $200 million for 202s for people with disabilities, the 811 program, $100 million for housing counseling, and $14 million for the Office of Fair Housing. The big bonus here is the $100 billion rental assistance program that is basically the Heck Brown bill, which you may have seen articles about and writing about. And let me break that one down. That allows the funds to be used for rent and rent-related assistance. All of the money must be allocated to people with incomes at or below 80% of area median income, 40% to people with incomes at or below 30% of area median, and cumulatively 70%, so an additional 30% can go to people at or below 50, and then the balance, which is 30%, to people below 80, but basically between 50 and 80. Now, it's really important to note that in the bill, the definition of income is the income that the tenant has at the time they seek assistance. So for instance, you could have a tenant who is 100% of area median income prior to the COVID-19 national emergency, loses all of their income, a very sizable portion of their income, and now has an income that is at or below 80% of area median. That family would be eligible for assistance, which is a little bit different than the way income is typically summarized. These funds are available for 3 years, and the rents can be subsidized. The rents that can be subsidized are up to 120% of the fair market rents or the small area fair market rents. The funds are distributed using existing McKinney Act allocations, which go to state and local governments. So that's the big support for rental housing. This bill goes much further than the CARES Act did in providing aid and assistance to tenants. There are also provisions for foreclosure and eviction moratoria. And in a surprise development, the bill also provides access to a liquidity facility at the Fed for mortgage servicers, which is something a number of us have been pressing for since the CARES Act went into effect and before, but also includes in that same section a provision authorizing the Fed to make low-cost long-term loans to owners of multifamily properties for the purpose of covering rent shortfalls. And that debt can be postponed for up to 6 months in terms of repayment and has long-term repayment plans. This came as a complete surprise to me. It mirrors a proposal that I made along with Carol Galante in a op-ed piece a couple of weeks ago, suggesting some kind of way for multifamily property owners to get access to funds to help bridge a gap between what they normally would collect and what they can collect while providing relief to their tenants. Owners who take advantage of this facility have to agree to no evictions, no late fees, and cannot discriminate on the basis of income in terms of their tenancy. Kind of a surprise development, but something that could actually be of great help to multifamily owners while they await the distribution and receipt of direct tenant-based assistance, which is, of course, the heart of the way this bill would provide aid. Julia, that's the big summary. I think the process going forward, obviously, is the bill has to get through the House. I think there's widespread anticipation this will pass on a party line vote. But then it has to go over to the Senate, where there's been a lot of resistance to another large piece of legislation. And to be clear, the HEROES Act has 12 or 13 titles. It has lots of stuff covering way more than housing. It's a big price tag bill. And as you know, Majority Leader McConnell in the Senate has indicated that he has very little appetite for another big spending bill, preferring instead to look at employer liability as the principal next step that the Senate has to take. Senator Brown, who's the ranking minority member in the Senate Banking Committee, is a big fan of much of what's in the HEROES Act, particularly the Homeowner Assistance Fund, which I did not talk about, which is a $75 billion fund to help pay for mortgage arrearages and other shortfalls for owners, but also has been a co-sponsor with HEC on the tenant relief bill, the ESG emergency rental assistance bill. How far that'll get us remains to be seen. The Democrats, as you know, have limited leverage, and there's a great deal in the HEROES Act for them to pick in terms of where they're going to make their stand and take the fight. But for now, we have a much, much bigger piece of legislation that cleans up some shortcomings in the CARES Act, particularly with regard to how mortgage forbearance works, how foreclosures and evictions following forbearance work, and as I said, contains an enormous, in comparison to what the CARES Act has, an enormous amount of direct rental assistance relief through a variety of allocation mechanisms. Let me stop there, Julia, and let me know if there's any more you want me to touch on, or we'll take questions from your audience.
Well, so I was hoping, there are folks on the phone who have rental portfolios, and I was hoping you would talk a little bit about the article or the proposal you and Carol Galante wrote about.
Sure. So Carol Galante and I authored a piece in Housing Wire a couple of weeks ago that stemmed out of our conversations about how to think about the most efficient way to provide relief for rental property owners whose tenants are unable to pay the full rent, or any or the full amount of the rent. Most of the proposals we'd seen to that time had proposed the assistance go directly through tenants, through the ESG program, through other forms of tenant-based assistance, which we agree is the ideal way to resolve this problem for low-income renters who have lost income and cannot pay the rent. The problem with that approach, we felt, was that it has a long runway. First of all, it had an uncertain future at the time, and still does. Number two, it has a long runway, as those of you who operate rental properties or have worked in this field know. The money has to get out to the allocating agency. The allocating agency has to develop a means to find and certify tenants. The money has to then get into the tenant's hands. There are questions about how do you ensure that the money is spent on rent? Does the money go directly to the landlord? Does it go just to the tenant and hope they pay it? All of those issues take time, as they should, because you want the program to be run with as much integrity as possible. And we were thinking, it's pretty hard to reach 10 million renters, just to make up a number. Wouldn't it be easier if you could find a way to also have a point of contact with 100,000 owners of rental housing who are the ones at the front line of dealing with a shortfall in rental income? We didn't see it as an either or. We saw it as a combination of aid that would complement one another and in effect be self-regulating. So what we proposed was a means by which rental property owners could get a line of credit, which they could use on a arrearages basis, so a month-to-month basis, to cover only the difference between what they had typically been collecting on average for any 1 month, let's say it's May, over a suitable prior period, so let's say an average over 3 years. And when they got the rent collections for May of this year, could submit bank records to certify what they had actually collected, compare that to what they would have normally expected to collect, and enable them to borrow the difference to cover their shortfall. So it would be on a 30-day arrears basis, but would provide a cash flow window for them. And then we propose structuring it as a low-cost, zero-cost, if possible, loan that would become due and payable either after the end of the emergency or as an underlying second that would be put on the property to be paid on sale or refinance. Our attempt was to find a way to help bridge the time between when owners start seeing shortfalls in rent collection and when other forms of assistance become available through the tenants to help make up those losses. That won't be a perfect fit in every case. We were anxious to make sure that owners had a way of covering their losses, but only the losses they could actually certify to and document, and nothing more. Some issues that have been arisen since we published the piece have been, well, why wouldn't you have the tenants pay it back? And how do you make sure that the owners don't just, end up bearing the entire burden of this exercise? I think that's a legitimate question. Once again, my bias on this was it's really important to get this done quickly. It's really important to put as few impediments in the way as possible. And then if you structure a very low-cost line of credit with very generous repayment terms correctly to property owners, it's an easier way, it's an easier path to have it become an obligation on the property than to try to round up the tenants and somehow make them pay past rents. A second issue has been raised about the moral hazard of how do you make sure that tenants actually pay the rent if they can. And I agree that is an issue, but it'll be an issue in any way we structure this kind of assistance. And one of the answers to that is because the landlord will ultimately have to repay the line of credit that they're being offered to cover these differences, they have an incentive to make sure that tenants who can pay do pay. Frankly, in listening to the reports from property owners around the country and a number of calls every week, I think what we've seen is that tenants are actually scrambling as hard as they can to make the rent. The problem isn't that they are, not paying rent in droves, but that they're struggling to do so. Rent collections have actually remained unusually high in the last 2 months. We'll find out later this month how things are holding up in May, and many property owners expect June to be much worse. But again, these are issues that are real and would need to be addressed. As I said, the HEROES Act appears to include a line of credit provision with the Treasury or a liquidity facility that in very broad strokes seems to mirror what we recommended a couple weeks ago. Again, whether that moves forward or not, whether it's adopted even by the full House or in the Senate remains to be decided.
Thanks, Barry. Erin, do you want to open for questions?
Absolutely. So just as a reminder, folks, to ask a question, you can either utilize the raise hand feature, the Q&A feature, or the chat. Barry, I do see that we have a point of clarification here around timing for temporary vouchers.
Right.
Can you clarify the 3-year piece that you discussed, please?
I can try. Hold on a second here. I gotta work off my notes. Apologies to everybody because I just got through the bill this morning. The Emergency Solutions Grant money is available for 3 years. There's a provision in the bill that funds that are not spent during that period of time roll over into the, I believe this is still the case, roll over into the Housing Trust Fund, which would then become available for authorized purposes in that act.
Perfect. Marsha, hopefully that answered your question. Additional questions from folks? Either the Q&A or the raise hand feature can be utilized.
Yeah, I see Julia asked a question about $1 billion in temporary vouchers. I'm not sure how many years those are expected to last. I would predict that if they're actually put out in the A, if they're authorized, B, if they're actually put out in the field, that it'll be very hard to take them back. Now, it's also possible that they'll be provided to people who only temporarily have qualifying income. And so there are two issues there. One, if a recipient who finds themselves, at 50% of area median today because they or a partner or another member of the household has lost a job, they are required under the vouchers to pay 30% of their income for rent. If their income doubles after 2 years at the end of the crisis, our experience with Section 8 is at some point the burden of paying your portion of a Section 8 voucher rent exceeds what you'd have to pay in market rent, and you just basically you give up the voucher. Second, if you're not in that circumstance and are at risk of eviction because a temporary voucher is about to expire, my money is always on expecting Congress to support existing support for existing tenants rather than further incremental support. So I think that's how that probably will evolve, but that'll be a fight we'll have to take on, when the temporary authorization expires, if in fact Congress passes this, and if in fact they allow the authorization to expire in the future.
Sure. This has been great information. Because of the breadth of information that we received, someone would like you to repeat the AMI information if you could.
Yeah, on the ESG money, the breakdown is as follows. So think of it as 100% has to go to people at or below 80% of area median income, right? And the rents that can be supported can go up to 120% of the fair market rents, either for the MSA or the small market area. So those are the two big limiters. Within the total, it's below 80% of area median. 40% has to go to people at or below 30% of area median, right? Another 30% has to go to people at or below 50%. So in total, 70% of the funding to people below 50%, of which a full 40% has to go below 30. And then the balance, which is 30% of the total, can go to people at or below 80% of area median. That's how I read the bill. I have to caveat that by saying I read it quickly. There was talk earlier about it going up higher than 80%, but that doesn't appear from my reading to be where it wound up.
Perfect. Next question from Adrian Knight. Are landlords going to need to apply for this directly?
Depends on what you mean by this. The tenant-based assistance, was that the question?
All I have is our landlords going to need to apply for this directly? So maybe more broadly, is there a piece of this that landlords will need to apply for directly as opposed to tenants?
As I read it, the ESG money goes directly to tenants, is designed to directly assist tenants. But I believe in the current ESG program, owners can apply, or owners can work with the issuing agency. The original ESG program is really quite broad. It's designed to help with emergencies, and as such, it was pretty flexible. I can look at this quickly while I'm talking. But it used to provide short-term or medium, I'm reading now from the bill, medium-term assistance with rent and rent-related costs, including tenant-paid utilities, utility and rent arrears, and so on. The people who are at risk of homelessness or income, we've talked about that, have an inability to attain or maintain housing stability. We talked about the income targeting. And I'm just going to see determining the income. I'm sorry to be doing it this way, but I've had so little time to read this. Up to 25% of this can be used for other McKinney Act related activities for relocation and so on, but only for people at or below 50% of area median. The allocations are as under McKinney. And I'm just trying to see if there's anything here for owners to directly get the money. And I'm going to have to say, I can't thoroughly and completely answer that question. So we'll have to get back to you on that. But my belief is this is all designed to go directly to residents.
Sure. Maybe one more question here. And JR, I do see your question. We're going to hold that for our policy conversation in just a moment. Julia, just for all folks on the phone, Julia also did put a link to the bill specifically in the chat feature if that's something that you'd like to look at. So Barry, maybe one last question. It says the qualifications typically prohibit many tenants and likely landlords from accessing this assistance, this assistance, particularly if they follow the standard public housing rules. Any details on owner interest rates and housing condition requirements?
Oh, that's a great question, and I haven't read it thoroughly enough to know how many waivers, if any, are actually in the legislation, or how much authority is given to housing authorities to waive certain requirements. That is one of that problem is one of the reasons that Carol and I collaborated on the proposal to provide aid directly to landlords, at least as an interim step. Because it's our experience that many landlords have trouble using Section 8 for a variety of reasons, including the housing quality standards, which can sometimes be burdensome for owners to meet. But I can't tell you with authority right now whether the bill waives those things or gives authorities the ability to waive them. It was certainly part of a conversation that took place with the committee staff as we talked about different forms of rental assistance. So I'm afraid that's the best I can do. I don't want to give you a definitive answer that turns out to be not right. So I'm going to back off and say I think it's a great question and one that we have to just read the bill more thoroughly. And again, remember, at the moment, this bill is just somebody's great idea about what to do. It's going to go through a long process, if not in the House, and certainly in the Senate before anything further gets done.
Wonderful. Well, thank you so much, Barry, for your time this morning. I know that all of our participants certainly appreciate the truly up-to-the-minute information that you were able to provide today. So thank you so much. You're certainly welcome to remain on the call, but at this point, I'm going to turn it over to Julia Gordon for our policy update.
Terrific. Thanks very much for letting me join you.
Absolutely.
Well, we were delighted to have you. Thank you for coming, and enjoy the reading of the 1,815 page bill. It's so much fun. And
Julia, there is a section by section summary they've posted. I will send that to you. Yeah. So
even the section by section summary is pretty long.
It is, when you have, 15 titles, it takes a long time to explain them.
But the good news is both the bill itself and the section by section summary on the link that I put in the chat area are word searchable. So you can look for specific things. I want to talk a little bit more. I don't think Barry spent a whole lot of time on this about what is going to happen with this bill. And then I want to talk specifically about a few provisions that NCST has been particularly engaged with. And I will answer JR's question at some point during the course of that conversation, because that's where it will come up. This bill was introduced yesterday. That's why we haven't read it in its entirety yet. Most of these sections have been worked on for quite some time. A number of us, Barry and myself included, have been involved in trying to help shape these sections, but the work on it was going on up until the moment it was filed. So even on the sections of the bill that, some of us literally spent hours on, we're having to go into the final thing and see what actually made it into the final bill. A lot ended up on the cutting room floor. What is going to happen next? We don't know. There's likely to be a House vote on Friday, assuming they manage to make the rules changes that they need to do this in a remote way. And then it is likely to sit there for some time. The Senate is taking this up. The Senate Democrats would like to see a bill along the same lines happen. But right now, the line from Republican leadership is, we're in wait and see mode. Let's see if what we've already done helps. Let's see what happens with the reopening, et cetera, et cetera. So I would say we could look at the House bill as the baseline. I think you can assume that for the most part, we would not get more than what's in the House bill under any circumstances. I think the House bill is the furthest bridge possible, so to speak. But you could certainly see a much more slender bill that may or may not include housing, or a bill that included just a few of the housing related provisions that are in this bill. There is, as I think I've mentioned before, there are many legislators who believe that issues like housing are better dealt with later in some kind of recovery bill, as opposed to right now, because they feel like the eviction prohibitions and the forbearance requirements, are kind of all you need for the immediate time. So we are, everybody's continuing to work hard on this. We will see where it lands. But this bill is an excellent opportunity if you have an interest in any of these issues and you read the bill and you see something that you like and you think would help your community, your clients, your business. It would be important to, certainly make your feelings about that known to the extent that you can, so that as this process goes through, it's always good for policy to be informed by the people out in the field who will be accessing these programs and additional support that's provided through this bill. I want to touch on a couple of different areas. One is housing counseling, which I know a lot of you have asked about. The bill does have $100 million for housing counseling. That is significantly less than what the housing counseling community asked for, but it still would be a very significant increase to current funding. There is an additional $1 billion for CDFIs. There is, as I think Barry mentioned, a program that would provide a total of $75 billion out to the 50 states and territories that would go through the HFAs to help with home ownership, to help folks reinstate after a forbearance, to assist those who have private mortgages that don't have forbearance provisions, potentially to assist with utilities and related costs that are not assisted by obtaining a forbearance on your mortgage. This bill was based on the hardest hit funds program that occurred during the last crisis, which only included 18 states plus the District of Columbia. This program would be nationwide, but the delivery mechanism would be through the state HFA. There are also very detailed provisions in this bill concerning how long forbearances should last, what should happen after the forbearance to avoid what you've all heard about, these lump sum requirements of repayment, and in terms of notice to borrowers about what their rights are and where they are in the process at any given time. So those are also, they're very detailed, they're useful to look at. Just to add on to this bill, while this isn't a policy comment per se, I hope everybody has seen the news that CFPB, FHFA, and the government lending programs have put together a information portal that Barry worked on. Barry, I don't know if you want to say anything more about the portal, but you're on mute, so.
Sure. Happy to quickly. A large number of 33 organizations, including the trust, signed a letter asking HUD, FHFA, CFPB, and Treasury to put a portal on the government coronavirus website specifically for housing, so that owners and renters could have an easy point of entry in a consolidated fashion to obtain information, which on the original coronavirus website was actually, you had to really dig around to find the links. They didn't quite do that, but instead the Bureau has hosted a new web portal page that has links to all of the other government agency provisions and has a terrific summary, which the Bureau had posted earlier, on what the CARES Act provides. I thought it was a good first step. I thought it was responsive to what they had been hearing from us and others who are advocating on behalf of more transparency and clarity for the people who are most affected by the crisis. I know that other folks are looking at it more closely and will probably be suggesting further modifications and improvements to the site. But I think it's a good first step, a little later than I would have liked to have seen, but responsive to concerns people have raised with them.
Thanks, Barry. So now I want to turn to JR's question, and a question I know a lot of you have, which is specifically for NCST community buyers. There are some things we would like to see in legislation and what's happening on that front. We've talked before about a proposal to create a new NSP type subsidy program for acquisition and rehab. And we've also talked about legislation that addresses the need to provide a first look to nonprofits and homeowners. Both of those things are very much in the discussion mix on the Hill right now, but have been deemed something that is more appropriate for the quote recovery phase rather than the rescue phase, and would be held over until that later bill that I think Barry might have mentioned before, where we would be focused more on infrastructure and similar investment. So that's where that stands right now. It is very good news that both of those ideas, as well as the Neighborhood Homes Investment Act, are sufficiently built out that, if and when we get to more of a recovery, investment, get the economy back on track type bill, that they would be ready to go. So I'll just mention a couple of other things so you know about conversations going on. There are still ongoing conversations concerning specifically single family rental and how the largely unsubsidized and really not connected to many government programs at all single family rental world fits into all of the government program rescue. Certainly a lot of the relief that Barry talked about is available to tenants in single family properties. But again, except for tenants who are renting in those properties with vouchers, there's often no connection at all to any of these government programs. So it will require significant sort of communications and messaging to get the word out, especially since, as we discussed, most of these programs are tenant initiated as opposed to landlord initiated. There are also ongoing discussions about something we talked about last time, which is the contraction in access to credit. Early returns or early data suggests that the contraction is pretty close to how much the credit box contracted after the financial crisis, which was caused by bad mortgages. So it just speaks to how deep this recession is and how much the economy has seized up and liquidity has disappeared, to see that access to credit is so constrained. Now, of course, it was starting from a much lower baseline than when we came into the crisis with what arguably was, way too much access to really unsafe and unsustainable credit. Now, most of the mortgages are much more safe, much more sustainable, and there's not as far to fall, so to speak. But it's of a great deal of concern to us that we see the credit aperture slamming shut the way we are seeing it. So that's something we're continuing to work on. Again, that's not something that's addressed in this bill, but it is something that's going to be on our minds, both from a legislative point of view, but probably much more important from a regulatory point of view. The regulators have a lot to do with the credit box, and then the lenders are placing their own overlays. For example, we are hearing there are very few FHA loans being made right now to borrowers whose credit score is below 680, and that's kind of astonishing. So we're considering this a matter of fairly urgent importance, and would love to hear any feedback from you when we open to chat soon on that particular topic as well. So Erin, I'm going to turn it back over to you.
Wonderful. Thanks, Julia. So at this point, we'll go ahead and we'll open things up for questions for Julia before we head into some questions that we have for our community buyers. Are there any questions today? Again, you can utilize the Q&A feature. You can use the chat, or certainly we would welcome raised hands, and we can allow you to ask your question. Not seeing any questions right now or any raised hands. We'll continue to keep that open. If you do have a question for Julia, we can certainly go back. At this point, we'll go ahead and transition to feedback from our community buyers. We do have a couple of specific questions for you this week, just given some of the changes that we know may be happening or have heard may be happening across the country. The first is, as Julia just described, related to capital. So we know that at one point, based on feedback from you, that capital really was frozen. We're hearing that in some instances that freeze may be thawing a bit. And so very interested in feedback from all of you about what's happening with your capital right now. Anyone with capital feedback? Quiet group this morning. Must have been so overwhelmed with all of the wonderful information from Barry that you're speechless. Our second question will be based, oh, we've got a couple of raised hands. Thank you, thank you. Carlos Nasip, I've opened up your line.
Hi, good afternoon.
Good afternoon.
Yeah, I'm calling out of Philadelphia. From our perspective, what we're seeing here, from most of the regional lenders and the local lenders, is that they're still dealing with the PPP rounds. So they're dealing with like the back end of those applications. So because of that, they're not really proceeding with business as usual and accepting or processing other loan applications. So that's really what we're seeing on that side. And then in addition to like the private lenders and the smaller boutique lenders, there's still a squeeze there because the secondary market is still shut down. So that's what, at least what we're seeing from the lending side out of Philadelphia.
Thank you, Carlos. Michael Smith.
Hi, good afternoon.
Good afternoon.
We've seen capital, some of our capital partners kind of just tighten their belts and kind of still a wait and see attitude. But the good news is we still do have some lines available. So we're just trying to navigate through and as we get through this.
Julia, I'm not sure that, thank you, Michael, for that. I'm not sure that you were able to see in the Q&A, Adrian Knight, I apologize, Adrian, I can't remember where you are in the country, but lenders there are still not funding. Looks like the rest, most capital is being used for employment. So it sounds like many of our partners are still having some challenges related to funding. Check the Q&A one more time here. She's in New Jersey. So New Jersey capital is still a challenge. Certainly we'll take additional feedback on that. The second question is really around this phase one reopening. So if phase one reopening has started to happen in your particular community, we're wondering how that's affecting your work, if at all. I know several states, Georgia coming top of mind, I believe Texas as well, was starting to open up. Just wondering how that's affecting the work of our buyers. Not seeing anybody. So either we're not in phase one markets, or it's not affecting work. Certainly we're open to any other feedback that you have locally about how things are going. Want to make sure that work is continuing, or that if work's not continuing, what are the barriers to that? If anyone has any feedback there. Still working from home, hopefully start opening in phases. REO market is still slow, it sounds like. Real estate market, excuse me, is still slow. West Palm Beach, Florida. Is that? Michael, go ahead.
I don't know if I was unmuted. Yeah, so we're still waiting for things to open up here in New York. It's going to be a while here for Long Island. A couple of the upstate regions have opened up, but our main market here on Long Island is still pretty much shut down. One person on a job at a time.
Got it. Julia, I'm not sure if you see the question here, but likelihood that the bill will be passed, expected pushback from the Senate, and what's being prioritized?
Yes, I did answer in the chat, and as Barry and I both mentioned, and I can't stress this strongly enough, the House bill will not be passed in its current form. It is very unlikely. The question is whether we'll call it bill number 4, will be passed at all the Senate Democrats are very focused on trying to pass another rescue bill, which would likely include much of what is in the House bill. Republican leadership does not want to pass another bill right now. So, happy to answer additional questions like that, but for those of us who work in the policy arena here in Washington, the most important thing continues to be working with regulators who have the ability to, push the various dials and levers to help keep the real estate markets functioning well, even if you don't see additional action from Congress.
Julie, it does look like also Florida continues to be able to do work, but seeing clients is a challenge. Real estate is continually slow. And approval for loans is becoming difficult, which I think speaks directly to what you were talking about earlier, related to the box that seems to be around some.
I mean, I'm curious if anybody had been working with potential owner-occupant home buyers who thought that they were fine in terms of a mortgage, and then as things became tighter, found themselves in a more difficult situation, and what the particular characteristics or requirements were of the lender that is putting the brakes on.
Perfect. And in New Jersey, just additional feedback there, waiting for towns to go back to being fully functional. Lots of delays with regards to permitting process and inspections. Title vaults are still closed. And it does look like, Julia, that folks are losing buyer. Yep, for sure. So I know that is at the top of our policy agenda. Kevin Moody, I've unmuted your line.
No, you haven't.
I did, and then I don't know. Kevin, are you muted on your side?
I'm sorry, can you hear me now?
We can.
Okay, good afternoon. I apologize for that. Yes, we're having a problem with a property that we had under contract that we were supposed to go to settlement on the 23rd of last month. Then the lender required them to have higher credit scores. Instead of them doing a verification of employment at the beginning and the end, they're now doing it for a third time with proof that they're still getting a paycheck. They re-verified their bank statements that the check was coming in. They've also required now a second appraisal. So we are just jumping through hoops and loops to be able to get a property to closing where we would not have to do otherwise.
Unfortunately, we've heard that story too many times. I feel for both our community buyers and those folks looking to purchase a home, just really challenging right now.
I'll say for those of you who have answered, I mean, I have what's actually written down in the chat. Kevin, if you would want to drop your CDM or somebody a line with what you just said with any more details. I am using your anecdotes in policy work every day. The more, when we collect enough anecdotes, we can almost say it's data. So, please let us know what's happening with you.
Any additional questions or feedback from anyone on the phone today? Oh, we do have one more here. Angela, Kevin is a community buyer trying to sell to a family. Kevin, do you have any more details? The question is the family having a hard time getting a loan? I assume the answer there is yes, but would like to hear from you directly.
Yes. Can you hear me?
Yes.
Okay. When the buyer originally came, as I always do, I contact the loan officer. The person came highly recommended. They did a tri-merge credit report. So when the contract was ratified, we thought that this was an extreme stellar buyer. Then right when the pandemic hit, we got notice that we wanted to try to rush this through because they were moving up the minimum credit score at that time from 620 to the 640. And this person was right there, borderline at the 640. So we were able to get that in. The appraisal came back. Again, now they're questioning the second appraisal to make sure that the values are going. So I just got an email from the loan officer today. Then they found one letter that was missing the buyer's name. So now it's going to have to go back through underwriting again. So I don't know if it's stall tactics or they're just really trying to dot every I and cross every T.
Right.
Thank you for that.
Something folks might
Go ahead,
not
Julia.
know is that in addition to the overlays, I think we've talked before about the problem that people are calling the problem of orphan loans, mortgages that close but then go into forbearance before they are in a Fannie or Freddie pool or a Ginnie pool. And in addition to the fact that there are, additional LLPAs being put on those loans, by Fannie and Freddie, we're seeing lenders charge their originators fees, like steep fees, if they close a loan that goes into forbearance. So I imagine everybody is going to dot every I, cross every T, maybe cross the I's and dot the T's just for extra. And that if they are worried at all, they're not even going to bother because these fees are so high, they pretty much take out whatever the originator might have made on the loan.
I know that Julia answered this in the chat as well, but just a quick reminder to folks that we do have a COVID-19 resources page that can be accessed from our website. And the bill link as well as the press release will be there later this afternoon. We will also make sure to link to the article that Barry and Carol wrote for Housing Wire, just so that you can have all of that information in one place. With that, Julia, I'm not seeing any additional questions or feedback, and I'll let you close out our call today.
Okay, well, I want to thank everybody for participating. In absentia, thanks to Barry Zigas for being with us today. I want to put in a little plug for our next call, which is 2 weeks from now. We will be joined by Mark Zandi from Moody's Economy. As you might know, Mark is one of the leading economists who focuses at all on the housing market. You hear him quoted all the time and on the radio and in the newspaper. And we are fortunate enough that he's going to be joining us. I hope we can have a good turnout for that and think about what your questions for Mark will be. We've asked him specifically to talk about what his projections are with respect to foreclosures, but he's an expert on, all things related to, I'll call it political economy. So bring your questions.
Wonderful. And Julia, one more additional question just came in, and I don't know if we can answer this now, but we do have a couple more minutes. The question is, thought rates were low and people were buying houses. I assume that the biggest issue here is the financing box, but if you maybe want to address that just quickly before we sign off.
Right, rates are low. Although because of the volume of refis that's happening right now and the capacity constraints caused by people not being in the office or whatever, rates are not quite as low as maybe they could have been given, given where the Federal Reserve is. But the problem that we're seeing is these overlays that have to do with credit scores and LTV. So for borrowers who have lower down payments or borrowers who don't have like truly spotless credit, it won't matter how low these rates are. They will not be able to take advantage of these rates to attain affordable home ownership at a time when you know, when it would be most affordable because of the rates. And that's why we consider this such an important policy issue.
Thanks for taking that additional time, Julia. And thank everyone for their questions. We look forward to seeing you on the 27th with Mark Zandi. And with that, we hope all of you are able to remain healthy and productive during the next couple of weeks until we talk again. Please do feel free to reach out, as Julia described earlier, to your community development manager, your senior asset manager, or certainly Julia or I directly with additional feedback, as we are utilizing that regularly for policy conversations. Thanks for your participation. We'll see you soon.
Bye-bye, everyone.